Today is the 8th of November 2021. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 just to follow up with what's happening there. And then I'm going to be introducing two new instruments. We took a poll on YouTube over the last few days. So if you are enjoying these videos, please make sure that you subscribe to our channel. In that way you will be notified when we conduct a poll. And we asked you what instruments you would be interested in seeing in this market update, and the winner by a good margin was the NASDAQ, and in second place was NIFTY-50 from India. It was neck to neck with the Russell 2000, and so I will be introducing the Russell 2000 soon as well. But those are the two new instruments that I am going to start coming back to occasionally. I hope during the course of these market update videos we're going to be taking a look at both of those instruments in today's video. So let's start with the S&P 500. I'm hoping that you have had a moment to read those disclaimers and make sure that you have understood them. Here is the S&P 500 and the analysis that we have been looking at for many months. So we're going to start here. This is the 54-month cycle trough, of course, in March of 2020. And you will know, if you have been watching these market update videos, that I have been discussing the potential formation of the 18-month cycle trough in the middle of July for some time. Now, of course, recently, price has been moving upwards very strongly. And if you go and look at recent market update videos, you will know that that was certainly one of the possibilities in terms of what we were expecting. The reason why I'm showing this analysis first is not because it is my preferred analysis. I'm not entirely sure that it is anymore. I think it is possible that the 18-month cycle trough itself formed over here at the beginning of October, was that, or the end of September? I think that's the beginning of October. I think it's very possible that the 18-month cycle trough formed then, and we'll take a look at that analysis in a moment. But the reason why I'm starting with this analysis is because I know there are many analysts that still believe that this is indeed the correct analysis. And I thought it would give me an opportunity to wax lyrical for a moment or two about the way in which a Hurst cycles analysis should be approached, which is that an analysis is as much an art as it is a science. And to some extent, we can never be 100% certain that we are looking at the correct analysis. What is important when we're working with the Hurst cycles analysis is that we're able to make consistent and profitable trading decisions on the basis of that analysis, even when there is some uncertainty. You will know, if you've been watching recent market update videos, that this has been a bit of a theme of mine, because it is such an important aspect of this whole approach to trading financial markets. So I'm showing this analysis first because it is, first of all, still a very viable analysis. It might be my preferred analysis, although, as I mentioned, I tend to think that the 18-month cycle trough has probably formed a little later than shown in this analysis. But here is the important point that I want to make. If you have been tracking these market update videos, you will know that we were looking for the 80-day cycle trough to form in the markets, which, according to this analysis, is what that trough at the beginning of October was. It was an 80-day cycle trough. And so in terms of the sort of time frame that I'm looking at with these market update videos, an 80-day cycle trough gives us an opportunity to enter into long trades, of course. And so that was our opportunity to enter into a long trade. So even if this analysis turns out not to have been correct, we were expecting to find the opportunity to enter into a long trade at this point here as price bounced out of an 80-day cycle trough. Now, of course, the price movement has been stronger than would have been expected if this was an 80-day cycle trough, or I should say only an 80-day cycle trough, because of the principle of synchronicity. Even if that was an 18-month cycle trough, it would also have been an 80-day cycle trough. And that really is the power of using this approach. We want to trade on the basis of an 80-day cycle trough forming. And if it was a greater magnitude trough, then all the better for us, because we end up benefiting from a more bullish move. And so that's why I thought I would start by showing this analysis. And let's just take a look at the composite model line on this analysis. The composite model line gives us an idea of what the market is expected to do when we look into the future, on the assumption that the cycles that we see in the analysis are what have been influencing price and that they will continue to do so. And so you can see that according to this composite model line, in other words, according to the implications of this analysis, we're expecting price to come down into this 20-week cycle trough, but not very much. That 20-week cycle trough is still expected towards the end of November, perhaps the beginning of December. We're still looking for a 20-week cycle trough, which is something we've been thinking about and looking forward to for some time. And so that trough is still expected, but as you can see, the price move down will probably not be a very impressive one. And generally, the market is expected to continue rising because of the influence of the longer cycles. We have the 18-month cycle pushing upwards, of course, the 40-week cycle pushing upwards, the 20-week cycle will soon be turning down, of course, to bring price into this trough, but there is a good deal of bullish pressure. So let's just zoom back out and show us the bigger picture there of what is expected according to this analysis. And you will notice the discrepancies between the composite model line and the price action, particularly around that 18-month cycle trough, indicating that that might not be the perfect position for that 20-week cycle trough. Now, in recent market update videos, I've been showing you what I call the default analysis, which, as I've mentioned in many of these videos, is simply an analysis that I have not influenced in any way. And you can see this default analysis is still stubbornly expecting an 18-month cycle trough to form over here. I think that's around about the beginning of December. We can look in a little more detail at that in a moment, but it is still expecting the 18-month cycle trough to lie ahead of us. And the details of this analysis I've looked at in previous market update videos. We have the 40-week cycle trough over here and the 20-week cycle trough over here. And so the analysis at the foot of the chart is a little more elegant, but it is probably, in my opinion, not actually the correct analysis. But why has it been useful to keep an eye on this analysis? Well, if I zoom in over this recent period of time, you will see that even according to this analysis, we were expecting an 80-day cycle trough to form over here at the same time. And so the same principle applies. When we were expecting an 80-day cycle trough, if we entered into a long trade at that point, which we would have done, then of course we would have been surprised by the excess bullishness, or the unexpected bullishness perhaps, on the basis that this was only an 80-day cycle trough. What encouraged me at the time to enter into a long trade as price bounced out of that potential 80-day cycle trough was the fact, as I mentioned in previous market update videos, that the time was just about right for an 18-month cycle trough to form, and so there was the potential that this would turn out to be an 18-month cycle trough. And here indeed is the yellow line, what we call the whisker, which reaches to each side of the circle of a particular cycle, indicating the range of time in which it would be reasonable to expect the 18-month cycle trough to form. And so the time was good in terms of potentially expecting an 18-month cycle trough to form over there at the beginning of October. And so if I show the composite model line according to this analysis, you will see a very different picture. And the reason for that is because it is working with the cycle information on this chart. And this is where we begin to really question this analysis. Up until this period of time over here, what's that, about the third week of October, the composite model line looked fairly good. There wasn't any indication that anything was wrong. But you can see that from about the middle of October, according to this analysis, the composite model line expects price to move downwards. Why is that? Well, because of the fact that it needs to get into an 18-month cycle trough over here, which has now slipped slightly to the right, and here's the nest of lows, so it's expected now in late December. The fact that there has been so much divergence between price and the composite model line gives an indication that this analysis might not be the correct analysis. However, even when we were watching an analysis that was potentially not the correct analysis, it did advise us to position for an 80-day cycle trough, or at least for a trade as price moved out of an 80-day cycle trough. Of course, according to this analysis, we would not have expected quite such a bullish move as price bounced out of that 80-day cycle trough. But the fact that we had the circle and whiskers for the 18-month cycle over there was an indication that we could have been standing by expecting an 18-month cycle trough to form early according to this particular analysis. In fact, pretty much dead on time according to the actual number of bars. So let's take a look at the analysis that shows the 18-month cycle trough as having formed over here at the beginning of October. Now you can see I have influenced this analysis. That is what this pin symbol is over here. And in fact, I've only influenced the analysis in one very simple way, and that is by positioning the 40-week cycle trough at this position over here. Now you can see that's an extremely subtle position for the 40-week cycle trough. So why is it that Sentient Trader has preferred to position the 18-month cycle trough before, in July, according to what used to be my preferred analysis, or after, over here in December, according to the default analysis? The reason has to do with the position of this 40-week cycle trough over here. That position, or at least that very, very subtle price trough that did form at that time, is really a very inadequate trough to mark as the 40-week cycle trough. But the important thing, in my opinion, when performing a Hurst cycles analysis is not necessarily to correctly identify every single trough that has occurred in the past, particularly when we're looking 9 months ago. Of course, it's important to know where the 40-week cycle trough did form when we are making trades on the basis of that cycle. But what is more important is that we end up with an analysis that is making sense at the moment. And when there is uncertainty, we might look at a few different analyses and work out what our level of confidence is. That's something I speak about often in these market update videos. And my level of confidence, as I mentioned, was certainly strong enough to enter into a trade as price bounced out of the trough at the beginning of October, which was at least an 80-day cycle trough, and quite possibly was the 18-month cycle trough, not the 54-month cycle trough. So let me measure the number of bars that elapsed, and you can see that there were 558 days that elapsed within, or I should say since March of 2020. The average length of an 18-month cycle is 546 days. So as I've already mentioned, time was right for an 18-month cycle trough to form in the market. And by performing this very simple little trick of asking Sentient Trader to position the 40-week cycle trough over there, I am able to obtain an analysis that looks really very good, apart from the potential position of the 40-week cycle trough. Now, did the 40-week cycle trough form at this point? In my opinion, it didn't. It either formed over here or it formed over here. Those are much better positions for the 40-week cycle trough. So why do I not bother too much about having positioned the 40-week cycle trough over here at this much more subtle trough position? The reason is because it doesn't actually make any difference. Remember that when we are about to make trading decisions, one of the most important things to do is to look at the recent average wavelength of each one of the cycles and look at when we are next expecting a trough of a particular cycle to form. And by positioning this 40-week cycle trough over here, instead of either over here or over here, in fact makes no difference to the average wavelength of that 40-week cycle. And if you don't understand that, I would encourage you to fiddle around a bit with the numbers. Try combining a short cycle with a long cycle, dividing them by 2, and I think you will get the same answer as if you had simply combined 2 medium length cycles. So that is, in my opinion, what is probably happening in the markets at the moment. In other words, an 18-month cycle trough has formed and we are seeing price bouncing out of it. We fortunately went into a long trade as price bounced out of what could have been only an 80-day cycle trough, but potentially has turned out to be the 18-month cycle trough. Let's see what our composite model line says in this instance. And as you can see, the message is very clear. Price is expected to keep moving upwards. In other words, we are in a bullish market and we expect to continue being in a bullish market. If you take a look at this composite model line, you can see that there are also discrepancies between the composite model line and the price action, as there will almost always be. The task of trying to find the perfect 100% accurate Hurst cycles analysis is probably not something that you want to be spending too much time doing. In my opinion, it's better to watch a few analyses that have the best chance of being the correct one and making sure that you are establishing your level of confidence and therefore making confident trading decisions as a result of that. So what are we expecting next in terms of the S&P 500? Well, we have three analyses to consider. The first is this one here, which in my opinion is likely to give us the better chances in terms of having matched price action more closely, and so we will consider this one primarily. You can see that at the moment price is expected to form a 40-day cycle trough. There's the nest of lows for the 40-day cycle trough. Where is that 40-day cycle trough? Well, let's measure the number of bars that have elapsed from that trough at the beginning of October, and you can see there have been 38 days. The average length of a 40-day cycle is 34 days, and so we're already 4 days overdue on this 40-day cycle. In my opinion, it is likely that the 40-day cycle has already formed, and if we take a look at the 20-day FLD, you can see that price hasn't come really anywhere close to crossing below the 20-day FLD, which is what we would expect it to do on its way down to the 40-day cycle trough. So what has happened to our sequence of interactions? Well, here is our A category interaction where price crossed up above the 20-day FLD. Here is, in my opinion, the early B and C category interaction, which occurred, and then suddenly, of course, the markets picked up an upwards draft and have been moving upwards ever since. We would expect a D category interaction as the 40-day cycle trough, as price moves down into the 40-day cycle trough. But it is fairly obvious and very clear that there is a lot of bullishness in the market. If indeed the 20-day cycle trough formed at this point, then the fact that price failed to even come down to the 20-day cycle FLD indicates the bullishness that was already present at that time in the market. And indeed, it is still present, as is clear from the price action. So in my opinion, the 40-day cycle trough already lies behind us, and the next trough that we're going to see is going to be this 80-day cycle trough here in the middle of December. So let's speak about that trough. You will know that in our different analyses, all of them are expecting a trough, of course, lying ahead of us because these cycles keep beating. So if we take a look at the analysis that we started with, and let's zoom in over roughly the same sort of time period, you will see that we have here exactly the same expectation for a trough, but it is a slightly different magnitude trough. It is a 20-week cycle trough. If we display the 20-day FLD here, then again we can see the same interaction between price and the FLD. There's our A category interaction. Here is our B category and C category interactions as price came down and did find support at the level of the 20-day FLD. According to this analysis, the 20-day cycle trough has been positioned, and indeed the 40-day cycle trough has also been positioned, and it is over here, where price came nowhere close to crossing below the 20-day FLD. Why is that? It's not because the sequence of interactions simply no longer exists. It's because of the amount of bullishness that is clearly present in this market, indicating that indeed the 18-month cycle trough almost certainly lies behind us, and very possibly formed at the beginning of October. So let's take a look at one of our new markets. Let's start with the NASDAQ. Let's start with a really big picture because I have a few points to make about this in terms of performing an analysis either in Sentient Trader or if you're performing an analysis manually perhaps. One of the questions that is often asked is how much data should I analyze? When Hurst was originally looking for his cycles, or I shouldn't say he was looking for cycles, but he was performing research on stock market price action, and of course he found evidence of cycles influencing the price action. When he was performing that initial research, he researched very long periods of time. He worked with data going back as far as he could, back in the 1970s. And some people today believe that that is the best way to achieve the best analysis. In my opinion, that is not true. Presenting a huge amount of data to Sentient Trader could be very useful in terms of establishing which cycles have been influencing that market over many years. But in terms of giving you a better idea of what is happening now, it is often better to show Sentient Trader less data or to perform an analysis over a shorter time frame or period of time. And the reason for that is because we really want to know what the cycles are doing now, not what the wavelength was 50 years ago. Because of the principle of variation, we know that the wavelengths do change. And so you can see I am only showing data going back to 2005 in terms of achieving this NASDAQ analysis. And you'll notice something else interesting, which is that it has positioned a prominent 9-year cycle trough back here in 2006. And that's a very questionable position for that trough. So why don't I tidy that up? Why don't I tell Sentient Trader that's wrong and that we should probably position that trough over there? Well, the reason that I don't bother too much about that brings me back to what is turning out to be a bit of a theme of today's video, which is that it's more important to me that we are looking at a good analysis of what is happening now in the market than worrying too much about what happened 10 years ago. Now, many analysts will disagree with me and will want to work on what was happening back here in the past. I don't worry too much about it because, in my opinion, the 54-month cycle trough that has been found in 2020 and indeed this 18-month cycle trough that we'll look at in a moment are correctly positioned, and they give us a very good analysis, and that is good enough for me because, particularly in terms of these market update videos, I am looking forward a period of time of only a few weeks really. I'm not looking ahead a year or 2 years and asking myself what is expected to happen. So let's take a look at what is happening in the NASDAQ, and of course this is also a market based in the US, and so there's a tremendous amount in common with the S&P 500. We have the 54-month cycle trough, as I've mentioned, in March of 2020. There it is. I have no doubts about the correct positioning of that 54-month cycle trough. And you can see I have not, in fact, influenced this analysis recently at all. And according to this analysis, the 18-month cycle trough formed in the NASDAQ at the beginning of October, which is another reason why I think that 18-month cycle trough is a good position in the S&P 500, as we have just discussed. You can see that in this particular analysis, we have a long 40-week cycle. Let's just measure the number of bars. There we go, 347 bars. That's a very long 40-week cycle. And then, of course, we have a short 40-week cycle, 211 or 212 bars that elapsed in that 40-week cycle. Now, some analysts would argue strongly that the position of that 40-week cycle is incorrect. And this brings me to another point about the way in which I have always performed a Hurst cycles analysis, and of course the way in which Sentient Trader does, because Sentient Trader gets most of its experience from me, let's face it. So that has to do with the pattern recognition approach to performing an analysis, which is what Sentient Trader does, and it's what I do, and it is the approach presented in the Hurst cycles course written by Hurst in the 1970s. In fact, in 1970 he first released it. And that is that what you do is you look at a wavelength. So for instance, for the 40-week cycle, the average wavelength of a 40-week cycle is 272 days. I think I'm correct in saying, there we go. So that would be the exact time at which, where the crosshairs are, at which we would expect a 40-week cycle trough to form. However, a 40-week cycle trough doesn't look as though it did form there. There's a much more prominent trough before it and after it, as I mentioned earlier when taking a look at the S&P 500. So more important than the exact number of days that have elapsed is that we are able to identify a fairly prominent trough forming as close as possible to that point. It's not only a matter of simply considering the 40-week cycle, it is also a matter of considering how the cycles fit together. We're looking at a fairly complex puzzle of all the different cycles that need to fit together. And so the first thing we would do is consider the longer cycle, the 18-month cycle. You can see here 561 days elapsed. The average length of an 18-month cycle, as I have already mentioned, is 546 days. So only, 15 days later, about 2 weeks later than expected, a fairly prominent trough formed. We had a good price move down into that trough, and we've had a pretty impressive price move up since that trough formed. And so that is a very good candidate for an 18-month cycle trough. Having identified that, we then need to identify the next shorter cycle, which is the 40-week cycle. And as I've mentioned, we would first look at about 272 days, and we would say, well, it must either be before or it must be after that. That is the way in which the analysis process works. In this case, the analysis has chosen to position that 40-week cycle trough over there. And as I've mentioned, that does not change the average wavelength, the recent average wavelength of the 40-week cycle, because a long cycle plus a short cycle divided by 2 is the same as 2 equally lengthed medium length cycles. I hope that makes sense. So this is, in my opinion, what is happening in the NASDAQ. It's the nice, clear analysis. It's a good deal clearer, I should point out, than the S&P 500. And if we take a look at the composite model line, you can see the composite model line is matching the NASDAQ much more closely than it did in the S&P 500. We still have some periods of discrepancy, but the general shape of the composite model line is much closer to the price action. And you can see that our expectations for the NASDAQ are all very bullish. So things are looking fairly good for the NASDAQ. That's, of course, according to this analysis. If we zoom in, you can see that we have the same situation in the NASDAQ as we had in the S&P 500, which is the difficulty in identifying the 40-day cycle trough. And here again, we can look at our 20-day cycle FLD. Here is our A category interaction, providing us with a target somewhere over here. Here is the 20-day cycle trough, and so our B and then C category interactions would be expected to form around about that time, which is over here, indicating that there is a lot of bullishness in the market, because instead of price finding support at the level of the FLD, price didn't even reach down to the FLD. And the 40-day cycle trough should have formed in the market, or it might be about to form. Are we expecting price to cross down below the FLD? I'm not really. There has been so much bullishness in this market that I'm not expecting price to even make it down to the FLD when it forms the 40-day cycle trough. Let's take a look at another market, and the other market, number 2 in our poll recently on YouTube, was the Nifty-50 from India. So here is the Nifty, and the first thing we're looking at here is, again, just a default analysis. I've just hit the Analyze button on Sentient Trader. This is data from Yahoo Finance, and it only goes back, as you can see, to 2007. And so that's only 14 years worth of data. Again, my points about how much data you need to analyze apply again. The Nifty, even though it is in India, is a stock market, and stock markets move with a great deal in common. And I think you can see from this analysis that we have, again, a 54-month cycle trough in early 2020, also in March of 2020. Here you can see an 18-month cycle trough, so we're going to discuss that in a moment. So it seems apparent to me that stock markets around the world formed a 54-month cycle trough in March of 2020. Perhaps there are some countries where that 54-month cycle trough was slightly displaced, but in my opinion, stock markets generally around the world formed an important trough of at least 54-month magnitude at that time. So let's zoom in and have a look at what has happened to the Nifty since the March 2020 54-month cycle trough. Here we can see our price action. And the first thing that is immediately apparent if you look at this analysis is that the 18-month cycle trough that has been found towards the end of July, which is fairly similar perhaps to my analysis in the S&P 500 that we've been looking at and discussing, has been positioned under a slightly questionable trough in the price action. The cycle shapes are not nearly as clear in the Nifty as they are in the S&P 500. There are various reasons for that. One of the reasons has to do with a fairly volatile currency. And so when you are looking at a stock market from any other country, you need to consider the currency and the valuation of that stock market, which is being valued in that country's currency. And so there's a very interesting discussion to be had, which I'm not going to do now, which has to do with looking at stock markets valued in other countries' currencies. So that's one thing to bear in mind. That's certainly something you need to consider when you're looking at a market such as the South African market. I know, as a South African, the South African market is greatly influenced by the very volatile currency in South Africa. And so the currency in India, the rupee, of course, needs to be considered when we're looking at our analysis. We're not going to get into too much detail about that here. But the point is that the cycle analysis will often not be as clear in a stock market from a country where the currency is a little more volatile. That's really the point. So in terms of this analysis, you can see we have an 18-month cycle trough formed at the end of July. That is not impossible. It does position a 40-week cycle trough over here a little earlier. That's in September of last year. And if we start measuring these wavelengths, you can see that we come up with some very different wavelengths that potentially are affecting this market. We have a 40-week cycle of only 184 days. That's very, very short. Most people would say 184 days must be a 20-week cycle plus an 80-day cycle. Couldn't possibly be a 40-week cycle. And then the next cycle is a cycle of 308 days, a very long 40-week cycle. So again, we are struggling to position the 40-week cycle correctly, even in this analysis. And so that certainly does call into question the position of the 18-month cycle trough. So is this correct? Well, I'm not sure that it is. The position of the 18-month cycle here at the end of July is really very questionable. As you can see, I have pinned this 80-day cycle trough over here, and if we zoom in, I think you will see why. If we focus only on this period of time, we did witness a good bullish move out of the July trough, indicating that this could have been an 18-month cycle trough. And then we had this trough forming over here. And if we measure the number of bars, I think you will see that that is very close to our expected average for an 80-day cycle. That is 65 days instead of the expected average length of 68 days. So that's a very good position for the 80-day cycle trough. What we have seen since then is the formation, probably, of a 40-day cycle trough over here at the end of October. There is that 40-day cycle trough in the analysis. So what are we expecting next? We're expecting a 20-week cycle trough to form over here towards the end of November or early in December. And if we take a look at the composite model line on this analysis, you can see that the move down into that 20-week cycle trough is not expected to be a very big move down. The reason for that is because of the upward pressure of the 18-month cycle and the 40-week cycle, which is still expected to be influencing the markets to move upwards. And so because of that, we're not looking for a very big move down. But we have to ask ourselves, is this 18-month cycle trough position correct? And if it isn't, then what else is happening? So before we do that, let's quickly take a look at our 20-day FLD, which we can also use to trade this market. Now, if this analysis is correct, and let me see if I can highlight that. There we go. If this analysis is correct, then we have witnessed a D category interaction as price crossed down below the 20-day FLD. It fairly accurately achieved its target. That is then the 40-day cycle trough, and price has just crossed over the weekend, in fact, above the 20-day FLD, generating a not very impressive upwards target of about 18,300, I think is about right. And so we would expect a little bit of a move up, and then of course price is going to come down into this 20-week cycle trough. So this market is definitely not exhibiting the same bullishness that we have seen in the US markets. So is there another possibility in terms of what might be happening? And let's take a look at what that could be, which would of course mean changing the position of the 18-month cycle trough. And here we have an analysis that shows exactly that. Again, I have very simply influenced this analysis by asking Sentient Trader to position the 40-week cycle trough over here, which in my opinion is a better position for that particular cycle trough. It gives us a very long 40-week cycle, as I've discussed in the other markets, but it does bring this analysis into line with what's happening in the other markets, except for the fact that here you can see the next 18-month cycle trough still looms ahead of us. So this is, in my opinion, the other possibility in terms of what might be happening in this market. So what can we do? We have two very different possibilities. And if we take a look at the most recent period of time and compare the composite model line, you can see the implications of these two different analyses. Let's display our composite model line. There we go. And there is the clear as day difference between these two analyses. The composite model line in this analysis is indicating that the Nifty must move downwards, or would be expected to move down according to the analysis at the foot of the chart into the 18-month cycle trough. So what is the situation in the Nifty? The Nifty is a more challenging market to analyze at the moment, and it often is a more challenging market to analyze because of various reasons, which I won't go into here, but it is certainly more challenging than the S&P 500 and the NASDAQ. So what is happening, and how can we make sensible trading decisions on the basis of this? Well, what I do, and I've mentioned this approach before, so I'm not going to spend too long speaking about it, but I do, first of all, identify my level of confidence in this analysis, or between these two analyses, I should say. My level of confidence is definitely not at the 18-month cycle level. I'm not very confident in the fact that the 18-month cycle trough occurred in July. And I'm also not confident that it's going to occur later. My level of confidence in this analysis is at the 20-week cycle level. In other words, I believe that the trough that formed at the end of July in the Nifty was a trough of at least 20-week magnitude. And if we take a look at both of these charts, we can zoom in over the same period of time, and here I will say I think that was at least 20-week magnitude, maybe 18-month, but definitely 20-week magnitude. And so our trading considerations come down to the fact that price is expected to form its next 20-week cycle trough over here towards the end of November. Now, one of two things could happen. If the 18-month cycle trough lies behind us, then our move down into the 20-week cycle trough will not be a very impressive one. We should be long at the moment to benefit from the move up out of the 40-day cycle trough up to this target. As price reaches that target or reaches towards it, I'm going to start getting a little anxious that maybe we're going to start seeing bearishness coming in as price moves down into the 20-week cycle trough, because of the fact that that might still be an 18-month cycle trough lying ahead of us. And so if we go back to our other chart and let's display our 20-day FLD, you can see that according to this analysis, price hasn't even quite crossed above the 20-day cycle FLD at the moment, but it is also expected to be bouncing out of a 40-day cycle trough, which very possibly occurred over there, and so we would get a target for that move up here. And then I'm going to watch this market very carefully, because it might very well turn down not only into a 20-week cycle trough but into an 18-month cycle trough. So we need to be careful of that if you are trading the Nifty. I do hope that you found this market update useful and interesting. Thank you very much to those of you who voted for our new instruments. I hope that you have enjoyed taking a look at a wide range of markets in today's video. I look forward to hearing from you. If you have any comments, please put them below the video.